In this lesson, Fibonacci retracements, the learning objectives are: you should know when Fibonacci retracements work best, and you should know how to trade using Fibonacci retracements. Fibonacci retracement is the most widely used technical analysis tool based on Fibonacci ratios. The Fibonacci retracement can be used when trading in any time frame. When price pulls back after an uptrend or a downtrend, that price pullback usually follows a certain mathematical relationship. The Fibonacci retracement calculates this relationship based on the Fibonacci ratios. Fibonacci retracement analysis can be used to confirm an entry level, a profit target, as well as your stop loss level. The Fibonacci tool works best when the market is trending. Buy at a Fibonacci retracement level when the market is in an uptrend, and sell at a Fibonacci retracement level when the market is in a downtrend. Fibonacci retracement levels are considered a predictive technical indicator since they attempt to identify where price may be in the future. You calculate the Fibonacci retracement levels by using the key Fibonacci ratios that are 23.6%, 38.2%, and 61.8%. The Fibonacci retracement uses these three ratios plus the 50% and 78.6 ratios. That means that there are 5 ratios in total. The Fibonacci ratio of 61.8% is considered a key level as it represents the golden ratio. The 61.8% ratio can be found by dividing one Fibonacci number by the next, as we mentioned 2 lessons ago. No, last lesson. The Fibonacci retracement of 38.2% is the second most important ratio and can be found by dividing one Fibonacci by the second Fibonacci, which is 2 places to the right. Sorry, let me make that a bit clearer. You find it by dividing one Fibonacci level by 2 Fibonacci numbers to the right. For example, 144 divided by 377. The Fibonacci ratio of 23.6% is the third most important ratio and can be found by dividing one Fibonacci number by the Fibonacci number 3 places to the right. For example, 144 by 610. Using the Fibonacci retracements. Although the Fibonacci retracement tools are widely used when trading, its subjectivity can oftentimes lead to erroneous readings when improperly drawn on a chart. What this means is that because you can interpret what the swing high means differently to how I may interpret what the past swing high is, we can have wildly different results when using it. So it's important that you understand how to draw it correctly. The Fibonacci retracement is applied by taking 2 extreme levels in a price chart. These levels are the peak and the bottom of a price move that can be in an uptrend or a downtrend move. When the Fibonacci retracement tool is applied, Fibonacci levels are shown as horizontal lines between the peak and the bottom. These 5 horizontal lines represent possible support and resistance levels. It is important to mention that these Fibonacci retracement levels should be seen as support and resistance areas and not as hard support and resistance levels. For an uptrend, put the 100 level of the retracement tool at the swing low and the 0 level at the swing high, as you can see on like you can see on the real world example here. For a downtrend, put the 100 level of the retracement tool at the swing high and the 0 level at the swing low. So as I said earlier, different depths or different retracements mean different things. We can consider a 23.6 retracement to be relatively shallow. These require a closer watch and quicker entries. Retracements in the 58.2% to 50% range would be considered moderate, and the 61.8% retracement is referred to as the golden retracement, as it is based on the golden ratio. If you trade a strong trend, then you should expect pullbacks to the Fibonacci levels at 23.6% and 38.2%. In normal trends, you should expect pullbacks to 50%, or most commonly to the 61.8% levels. In general, give extra weight or extra meaning to 38.2% and 61.8% retracement levels. One of the key advantages when trading using the Fibonacci retracement is that you can identify the optimal stop loss levels at a glance. An aggressive method would be to set your stop loss just past the next Fibonacci level. For example, in a downtrend, if you felt like 50% would hold, then you would put your stop loss past the 61.8% level and enter at the 50% level. Because if price were to rise beyond this point, your trade would be invalidated, meaning what you saw doesn't make any sense and the price is not acting based off Fibonacci levels. The problem with this method though is by setting stop losses that close, it is entirely reliant or dependent that you have a perfect entry. This market, which could be the euro to US dollar, could shoot up for some unknown reason, hit your stop loss and eventually go in your direction. So I'll say that this method works best for short-term intraday trades. A conservative method would be to place your stop loss past the recent swing high or low to be a little safer. For example, if the price is in an uptrend and you're in a long position, you can place a stop loss just below the latest swing low, which acts as a potential support level. When the price is in a downtrend and you're in a short position, you can place a stop loss just above the swing high, which acts as a potential resistance level. This type of stop loss placement would give your trade more room to breathe and give you a better chance of the market to move in your favor. Because if the market price was to surpass the swing high or swing low, it would mean that your trade setup would be invalidated just like for the aggressive entry. But the problem with this method of setting stop losses is that you may incur large losses, especially if you enter at one of the earlier Fibonacci levels. Setting larger stop losses would probably be best used for longer term swing type trades. I have some basic tips if you intend to use Fibonacci retracement levels. Number 1, do not use Fibonacci retracements during important news releases or after key fundamental changes. Number 2, the levels generated by the Fibonacci retracement should be seen as general support and resistance areas and not as hard support and resistance price levels. Number 3, it is better to wait until a price reversal has already occurred close to a Fibonacci level before opening a position. It reduces your risk and makes the trade much less likely to go down because it's already going in your direction. You're almost riding the trend. Number 4, you should give extra weight to 38.2% and 61.8% levels. These two Fibonacci levels are the most important retracement levels. Number 5, you can apply multiple Fibonacci retracements on different swing highs and lows and different time frames. And number 6, it is better to confirm any signal generated by the Fibonacci retracement with another tool.